It is a great day here in Conway, South Carolina, where we are talking with you guys and discussing the tax secrets that we should all be aware of as a business agency and as a new startup. We are joined today with Kevin Linhart of Homecare CPA. Kevin has been with us in the past and has shared with us some other secrets. In our last broadcast, I had actually challenged Kevin and said, all right, Kevin, you know what? These secrets are so great. Give me 100 between now and the end of the year. And Kevin, he took on the challenge and he said, let's do it. So here we are with our next segment of the 100 tax secrets. Joined with us, Kevin Linhart from Homecare CPA. Kevin, welcome again.
Thank you. Thank you. Happy to be here.
Wonderful, wonderful. We've got some great questions, and I know that you are ready to delve in. And the first tax secret that we have out of the 5 that we're going to be talking about today is the Section 1202 exclusion. Now, that sounds so infamous. What is it? Tell us.
Yeah, so the Section 1202 exclusion relates to qualified small business stock. It's a little-known benefit available to C corporations, and it's really used as an exit strategy for businesses who are looking to sell in the future. It's a way to exclude up to $10 million of that capital gain. Now, there are some other requirements that need to be met in order to qualify for this exclusion, but it is definitely a lucrative tax strategy to take if you are looking to sell your business in the future, because not having to pay taxes on up to $10 million of gain is a huge amount.
Right. That capital gain can kill you. So when one of our owners, Kevin, in your professional opinion, when would a owner start actually thinking about, what's that exit strategy? How am I going to, go through an acquisition? Am I going to sell? How do you start preparing for that? And then, of course, looking at this 1202 exclusion and seeing how all of that is going to play out at the end of the day.
Yeah, that's a good question. So that's actually one of the questions we ask when we start working with our clients with the tax planning. What is their goal with their business? Is it to, pass it down their family? Is it to eventually sell? So that's something we kind of start with them right away and really find out what their plan is with their business. So because with this exclusion, there is a requirement as to how long you have to hold the stock. So it's definitely good to know from the start if the plan is to sell, so we can get this set up and make sure it's good to go when that time comes.
And I want to just turn the compass back into the same question, but just ask you to elaborate on what capital gains actually means for our viewers and to our business owners. What is that element of that calculation that quantifies capital gains? Can you just explain that a little bit more for us?
Sure. So your capital gains would be a sale of an asset that is held for longer than 1 year. It's most commonly associated with selling stock held for over a year. If you sell it for a gain, you're taxed at a capital gain. And currently there are different capital gain tax percentages rather than your ordinary tax brackets. They're a little bit lower currently. I know President Biden is looking to increase the capital gains tax brackets. He's looking to make those rates higher. So and this is something to consider as well.
Right.
With the possible tax changes that are coming.
Right. Interesting. So let's move on to the tax secret number 2. I consider this a relatively big one, only just from a standpoint that we're using it all the time, and we sometimes can be very amiss to even consider this, right? So Our tax secret number 2 is automobile or vehicle, car. I would even say even fleet, right?
Right.
Automobile expenses. Tax secret number 7, which is number 2 of today, but number 7 in total, is automobile expenses. Can you elaborate?
Yeah. So I feel like you're probably thinking, automobile expenses. How is that a secret? But there's really two methods that are used for figuring out the deductible car expenses. You can either use the actual expense, which would be things like the depreciation, the gas, the tires, the repairs, or you could use the standard mileage rate. And the secret piece of this is actually that the standard mileage rate often gets you a higher um, deduction than using the
Right,
actual expenses. Uh,
right,
so, for examples, let's say you have a car that you use for business, you get 30 miles per gallon. That 30 miles is business use. A gallon of gas might cost you. I know it varies all over the U.S., but let's just say $4. So that $4 for that gallon of gas now becomes deductible. But if you use the standard mileage rate, that is 56 cents per mile.
a
So
mile.
that
Mhm.
30 miles you've driven now becomes a little over $15 of a deduction. Um,
And so let me ask another question as it relates to the automobile. Let's say that we have an owner. Not only they're using their own vehicles for business purposes, and we've got the calculations where whether we're using the standard mileage or we're going based on the standard formula. But what if I have staff, I have liaisons, I have marketers who are also out in the field? What would be your recommendation? And again, knowing that you're working and you're entrenched in home health, and I know that you've seen this, what would be that formula would our owners be looking to use when it comes to another employee who are also using their vehicles to go out to clients, to go out to referral sources, to promote their business? What would be your recommendation, Kevin?
Yeah, the most commonly used thing I see is a reimbursement of the mileage rate. I
Right.
think it's easier to calculate rather than tracking all the actual expenses that your employees, your caregivers might incur in their automobiles. And like I mentioned, it's a little bit more than what the actual expenses usually are. So it's kind of an incentive uh, for your employees as well. Um, so another way to kind of
Right,
incentivize
right.
your caregivers and hopefully retain them.
And I would say to everybody that is listening, do not be afraid of submitting to your CPA all of your mileage or your gas vehicle expenses, even whether it's your actual insurance payments, the repairs, you're changing of your oil and so forth. Your CPA is going to create that best strategy for you.
Right.
So don't be afraid and just don't think, oh, well, I shouldn't include that, because it's not really, put it all in. Your CPA, right, Kevin? You'll be the
Right.
one that is going to say, yep, no, I'm going to get rid of that. I'm going to keep this based on what your state is dictating, and those different nuances. But don't be afraid of listing it and allowing your CPA, your accountant, to determine the best strategy for you when it comes to those write-offs.
Right. And with the standard mileage rate, I'll add it's important to keep a mileage log, whether that's a notebook where you write down, keep track of all your business miles. Just picking out a number out of thin air at year end isn't going to
Right,
fly for
right.
the IRS.
Right. Easiest way, put it on the timesheet of
Yeah.
your employee, have that section right in there. And I'm sure, Kevin, you've got those forms for the timesheet as well as those other um, um, reimbursements for employees as well.
Right.
So our next one, number 3, is, and again, this is something that we just take for granted, right? We're setting up, we're putting a little desk, we've got our little computer, we're sitting in the corner of our room, and we are doing business, right, in our home. But your home office, guys, is a write-off. Let's go into that, Kevin.
Yeah, so your home office, you do get a deduction for it. And again, there's two different ways to calculate this. There's a actual expenses method where we take your actual expenses, which would be electricity, internet, your telephone, um, things like that. Then we calculate a percentage, which is basically the square footage of your office divided by the total square footage of your home, um, and then apply that percentage to the actual expenses incurred, um, to get your deduction amount. And then there's also a much more simplified way, um, which I believe it's $5 per square foot of your office. Um,
Right.
you could just do the $5 per square foot. But again, in this case, usually actual expenses will get you the larger deduction. But of course, there's more, uh, keeping track of receipts, um, keeping track of invoices. So it's a little bit more involved, but it usually does get you a larger deduction.
Right. So, and again, just to elaborate, we're talking about the actual office space, the square footage in your home office. It does not, it also includes, and correct me if I'm wrong, Kevin, your actual furniture, your desk, your chairs, computers, and so forth. All of that can also be included in that deduction, correct?
Right, right. If you purchase that for your business and use it in your business, that is definitely a deduction. So yes.
Right. Here's another one that has taken me aback. I've not heard of this term before. The accounting expenses. Tell us about that secret.
Yeah, so this is definitely a good one. So I come across a lot of home care owners who try to do their accounting work themselves. But the accounting fees that you pay to an accountant or CPA, all those fees are deductible. Um, those all reduce your net income at year end. They're going to reduce your tax liability, and uh, a good CPA is going to save you more money than you spend on them. Um,
At the end of the day.
right.
So the moral to the story is that if Kevin is billing you guys, $125 an hour, don't fall off your chairs yet, because just know that at the back end of it, there is that expense, the accounting expenses that can also have that element of deduction for you. So Kevin is saying here that, it's going to work out a little bit more favorable. But I have to check into that, Kevin.
Right. Right.
You said that too easily. I have to
Right.
check into that. So I
Well, like
have a
you
question.
had mentioned earlier, we're gonna look at the different automobile expenses and make sure we get you the largest deduction possible for that. We're gonna compare the two home office deduction methods, make sure you get the largest deduction for that. So that's where hiring that accountant comes in handy. You get those
Oh,
other
absolutely. Yeah,
deductions.
you couldn't be without an accountant for sure. You can't do it without them. So I have Takesha Taylor, who has just posted a question, and she's asking, can you use your home office and business office and supplies as a tax credit?
Right. So if you have a business, an actual building for your business and a home office where you perform your administrative work, that home office deduction is still available for you, and your office supplies, as long as you're using it for your business, paper, ink for your printer, stuff like that, that is all deductible.
I thank you so very much for that question, Ms. Takesha. I appreciate that. Please continue to throw questions over here to Kevin. He's here to answer some of those very, very burning questions that we may have. So thank you very much for that. So our next one is qualified business income deductions. That's a big one. I had to look at that one. Qualified business income deduction.
Yes.
Tell us.
So this also called QBID. This came about with the Tax Cuts and Jobs Act back in 2017. Um, And it allows eligible taxpayers to deduct up to 20% of their qualified business income, which is the net amount of qualified items of income, gain, deduction, and loss from any qualified trade or business. Um, and the reason why this is a tax savings secret is because there is income limitations to this. There is also limitations if you are a certain types of business. There's income limitations for it. So we would take a look and see if there's ways we could do some income shifting. Income shifting being where we look at the other tasks that your business offers. Maybe we split them out into two separate businesses. A good example would be a client I work with. They are home care, but they're also a staffing agency. So in order to maximize this 20% deduction, we might split that out into two companies instead of one, just to get around the income limitations.
Right. Gotcha. So multiple entities who are potentially sharing the same tax ID number, because if they're two separate tax ID numbers, you couldn't blend that, right?
Right.
So same tax ID number, we may be doing two locations, same tax ID number, but one is doing one service line, the other one's doing the other service line. Bringing it all together, you'd have to look at the two to determine what qualifies under that business income deduction.
Right. And also C corporations aren't eligible for this deduction. So if you're a C corporation, that would be something we also look at, maybe switching to an S corporation. So you would become eligible.
Right.
That would be kind of part of the tax plan that we would do, comparing the two types.
And let's just touch on that very, very quickly before we go into our last tax secret here, Kevin. C Corp, S Corp. I know and I hear it all the time of the confusion between the two. I'm still an LLC, but I've got a C Corp, S Corp. What is the difference? Can you just give us a quick, snapshot of what that is?
Sure. So an S corporation is it's a pass-through entity. You could be an LLC that's taxed as an S corp, meaning the income that you earn from that S corporation business flows through to your Form 1040 individual tax return.
Right.
You'll have to file an 1120S tax return, but you actually don't pay any tax on the 1120S tax return. The income flows through to your Form 1040, and then you pay the tax on your Form 1040. A C corporation is a completely different entity. You would file a Form 1120 tax return. You would pay the tax on the Form 1120 tax return. That income will never show up on your individual tax return unless you take dividends from the C corporation. Then they would go to your individual tax return and be taxed as dividends, which is where the double taxation issue comes up with C corporations. And with that, you're probably thinking, why would you want to be a C corporation if you're going to get taxed twice? But C corporations currently have a flat tax of 21%. So whether you make $100 or $100 million, you're getting taxed at 21%, which is much lower than the tax rates on your individual Form 1040.
Right. And one of the things I'd also want just to bring also to the table here is that you may start out at starting out at a C Corp, for example, and you are able to change if need be, right, to an S Corp. I know for myself, when I first started, I didn't know anything. I didn't know from a hole in the wall and started out as a C Corp. But then obviously once I did get myself the accountant that was here in my corner, we looked at how everything was going to be established and made the decision to then change to an S Corp. So that is possible, guys. If you feel and your accountant feels that, you've started out maybe under the wrong category, you can most definitely change. Whatever's going to be best suited for you your numbers, your business, and obviously for your own personal self as well.
Right. And I would recommend, if you're just starting out, just go with the LLC for now. The S Corp and the C Corp have some complex reporting requirements, and really, until you're making really good money, you're probably good starting off in just the LLC.
Right, right. So our last one here, Kevin, I'm excited about this one because this one I know about, and I'm actually in the process of doing this myself. The Employee Retention Tax Credit, the ERC. This is, I think, for everybody to listen to and to pay attention to. We've recently gone through that bout of the program that we had for the oh my God, the name of it's just like gone out of my head. But we recently went through it and was able to apply for certain credits to our companies. The PPP loan, there we go.
Right. Right.
And the ERC, the Employee Retention Tax Credit, is something that there's not many people that are aware of it. So please, guys, get a pen and paper, take some notes on this. This is important. So Kevin, let's go into this. What is the Employee Retention Tax Credit all about?
Yeah, it's definitely a big credit. And like you said, not a lot of people know about it. But yeah, it's the Employee Retention Tax Credit. So this came about during the original CARES Act. It was a way for the government to incentivize businesses to keep their employees on payroll. And it started out as a credit of up to $5,000 for each full-time equivalent employee you retained from March 13th, 2020, so right when the pandemic started, to December 31st, 2020. So for each employee retained during that time, if you paid that employee at least $10,000 or up to $10,000 in wages, you would get $5,000 back on those wages. And then came the next act. I think it was the American Rescue Plan Act. They made some changes. So now you're also eligible to claim this credit in 2021. And it's actually 70% of employee wages up to $10,000. And it's per quarter. So that's $7,000 per quarter per employee that you paid up to $10,000. So if you paid less than $10,000 to an employee, if you only paid $5,000, that's perfectly fine. You would get 70,000 or 70% of the $5,000. And it's a reduction of payroll taxes first,
Right.
and then any remainder is an actual check, an actual refund check that the IRS is gonna send to you.
Right. And in addition to that, though, you can actually opt to have it all as a check, as opposed to it being offset on your unemployment taxes. So, guys, if you have this application in progress and you get approved, okay, again, it's going to go through similar steps as the PPP loan, and they approve you and they say, okay, then yes, we can give you $30,000. Okay, that $30,000 can be offset either in the reduction of your unemployment taxes that you pay from payroll to payroll, or you can actually have that and say, no, I'm opting to actually have that income to yourself. Am I right in saying that, Kevin?
Right. So the way it works is it's filed with your Form 941, your quarterly payroll tax form. And like you said, you can either take the benefit now and just reduce your payroll taxes on that form, meaning you won't pay those payroll taxes. You keep that money in your bank account, or you can request the refund check. And you can also amend the 941 for prior periods. And in those cases, it would be an actual check from the IRS as well.
And that check that you receive is not actually going to be recorded as income, correct?
Correct. Now, the slight downside to this is those those wages are no longer allowed to be deducted on your tax return.
Mm-hmm.
But the 70% refund that you're getting greatly outweighs the little bit of extra tax you'll have to pay because you won't be able to report those wages as expense on the tax return.
So for how long a period of time are you unable to report that? Is, once you've done it forever and a day, you cannot report that for that particular employee? Or is there just for that particular tax period?
So it's just for that tax period. So if you're only doing like Q3 of 2021, you would not be able to report that employee's wages just for that quarter. The rest of their wages will be includable on your tax return.
Right.
And
so like you said, it's not really worth worrying about, really.
Right. Yeah. I mean, the refund that you're getting is going to greatly outweigh the little bit of increase in tax that you'll have to pay because your business is going to show a little bit higher income than it normally would.
Right. And are there any criteria in which if I opt for the IRS to send me that check, I'm opting out of having it reduced on my SUI, is there any restrictions on how I spend that money? And then in turn, what is going to be, in terms of the audit, right? Am I going to be audited? What kind of documentation do I have to maintain in terms of where that money went to? Are there those things that we need to also be thinking about, Kevin?
Yeah, from what I've read, I haven't seen anything restricting the use of that money. So once it's yours, it's yours. You can use it as you please.
For your business.
Right. For your business. Yep. And then as far as audits, I'm sure they will audit this employee retention tax credits. But just make sure you have your, all your payroll reports in line. Make sure you're not abusing it. And that's where it comes in handy to have a CPA who's going to, take care of all this for you. And one thing I forgot to mention with this, there's actually some qualifications that your business has to meet first. So
of course, right?
Right.
You can't just get it.
Right. And that's going to give refund checks to everybody. So for 2020, to qualify, your revenues had to have fallen below 50% of the same quarter in 2019. So you would compare, Q3 of 2020 to Q3 of 2019. And
Right.
if there's a 50% reduction in revenue, then you would qualify for that quarter. And that bumped up to 80% in 2021. I'm sorry, 20% reduction in 2021. So comparing a quarter in 2021 to 2019, you would only have to show a reduction in revenue of 20%.
Right.
Then there's also another way to qualify called the startup recovery business. And this is a business that was started after February 15th, 2020, and they have less than $1 million in annual revenue. Those are the only two requirements. You don't have to prove the reduction, either the 50% reduction in revenue or the 20% reduction in revenue.
Right.
You just have to be started after February 15th, 2020 and have less than $1 million in annual revenues. And that's probably the most common way that I've seen home care businesses qualify is the startup recovery.
The startup recovery.
Right.
So we have many people in our home care business advisors group that would most definitely, work for. And a lot of what the ERC is doing, it really does resonate, and it's copycatting a lot of the pieces of the PPP, right?
Right.
I see that. So I do have Lakia, who has asked a question. Is it too late to apply for that, for the ERC?
So it's not too late. So, the 2020 is passed, but we can amend the 2020 941s and so we're almost done with quarter 3 of 2021 already. But again, we can amend those 941 returns, and we can go back 3 years to do that. So I guess that would be 2024. We would still be able to go back and claim this employee retention tax credit.
Wow. That's awesome. That's awesome. And I know there are some companies out there just specifically, processing, applications for the ERC. Again, guys, I'm always going to defer you back to your CPA, to your accountant. Okay. They need to be your quarterback. They need to be your backbone in terms of some of these programs that are out there. In the long term, can it affect you? Can it be of aid to you? So you have to determine that, but sit with your accountant. Kevin, as always, information was great. This is your first session in hitting that 100 tax secrets. So far, I'm impressed. But how do we get in touch with you? How does our viewers get in touch with you if they do want to speak to you in more detail, and especially about that ERC? I mean, out of all of those areas, that ERC could, make a day into night for somebody. How do we get in touch with you, Kevin?
Yeah, absolutely. And especially I'll add with the ERC, the big thing going on right now is the caregiver shortage. So knowing that you're going to get 70% back on those employee wages, you're able to maybe pay a little higher wage for caregivers, maybe either retain them or attract new caregivers. So that's a benefit to the ERC as well. But yeah, try to make it super easy to contact me. My email is kevin@homecarecpa.com. My website's homecarecpa.com. From my website, you can schedule a free meeting with me. It'll be a Zoom meeting. We can talk about claiming this credit for you. We can talk about your other accounting needs and how I might be able to help.
Thank you so very much, Kevin. We have covered enough to be chewing on, and that has most definitely whet our appetite for sure. We're going to be back again with another 5 tax secrets. Guys, please just, keep an eye out on the Facebook page. You'll be seeing those coming up. Join us for our next segment. I'm excited to see the next 5, Kevin. Keep up with those 100. By December 31st, we have to deliver 100.
Right.
You still in?
It's going to be hard, but I think we're gonna make it.
You're going to make it. My money's on you, Kevin. With that, I'm going to say thank you. As always, have yourself a great and wonderful evening. For everybody who is out there watching this evening, thank you so very much for joining us also. If you're not and have not touched over onto our YouTube page, please go ahead and check that out. Go onto our website. We've got some new things and some new branding coming out. We have a home care conference coming up in 2022. Exciting things going on. So keep tuned, keep staying in touch, keep onto our website, and keep listening. Thank you so very much. Good night.